Okay, let's go over investments. So I see a lot of videos that have a bunch of misinformation and just not even knowing what they're talking about. So I'm gonna give my shot at it, and hopefully I fill in a bunch of the blanks for people actually interested in learning this. But I'm not an expert, and disclaimer here. All of the numbers that I'm using are just purely made up numbers. You can look up the actual rates if you want, get a better idea of the exact numbers that you're working with, but the concepts will be the same. So let's go over the three types of long-term investments. Um, there's other options. You could buy gold, you could buy real estate, you can do whatever, but uh, we'll be talking about simple investments. So there's individual brokerage accounts. You buy stock and you hold it into retirement. Um, be careful of these accounts. You have to track your holdings and make sure not to sell stock until it reaches long-term stock status, which is after 1 year and 1 day. Short-term stock is taxed differently and generally much higher, and the taxes will quickly screw you out of any profits. You only want to be doing this type of investing if you have some income that you may need immediately. So you want to have a buffer that you can withdraw from. You have some expenses, you need to meet a down payment on your house, whatever your expenses are. If you think that you will have some, but you want to increase your overall investments, then you might have this sort of an account. You also only want to do this if you're self-managing your assets to maximize your growth. And obviously, you need to know how to choose high-performing stocks. But most importantly, this option is the best for people trying to retire or soft retire at an earlier age. As the other two accounts, you can only start withdrawing without significant penalties after a certain age, 55 or something like that. But anyways, Roth IRA. Roth IRA is taxed as it goes in at your income tax rate, but it's tax free when you withdraw the money. We'll go into this, but that's the basic of that. Pre-tax 401ks are pre-tax contributions. Um, they reduce your income, which could be important if you're um, in a particular tax bracket. You might be saving a significant amount of money that is going into investments that instead of going into taxes, or you might not, but keep that in mind. This means more money goes into your investments and it grows, and so you have a larger amount when you withdraw it. But when you withdraw it, it counts as income and it gets taxed at an income rate. When you withdraw your pre-tax 401k, you can add that to whatever income you have. If you don't have any income, then it's just regular income. I forget the specific legal term for it, but and then a quick aside here, if your employer matches any contributions, always take them up on that. It's free money. It doesn't matter if they're saying you can only put it into this account, you can only put it into that account, you can only do this, that, whatever it is, like 99.9% of the time, just completely max that out first and worry about any other investments after you do that. Um, and if this like brings you up to a new overall contributions and you can allocate your money differently. If they say put it into this account, you can take your money and shift it into another account, whatever you want to do with it. So let's just make up some tax brackets. We have 0 to 10K at 5%, 10 to 80K at 10%, 80 to 200K at 20%. Let's just assume you're not going to be making more than 200K. If you're making more than 200K, you need a different video. Go look up high income investment strategies or whatever you want to do. Um, so let's take a look at a guy named Bob. Bob's a simple man. He builds things. He's not too financially savvy, and he got some advice to put all his money into a Roth IRA. He doesn't invest anything himself, and he doesn't mess with this pre-tax contribution stuff. He just throws it all into his Roth IRA. Let's see how this advice works out for him. So he has an income of 100K. Let's just assume he keeps that income rate for the rest of his life. Um, you can do some fancy stuff here, but I'd rather just keep it simple. Uh, and since we're on the topic of income and we're about to go over tax rates, let's debunk some actual ludicrousy that I see online. You will not make more income and take home less money in terms of taxes. Now, if you fall into a new bracket and some benefit that was afforded to you goes away, maybe you are at work and they say, hey, if you make over this much, we're not going to pay for your insurance, whatever it is, maybe then you have to consider it. But almost all those types of things, they're on a sliding scale, and it's normally not the case where you make more and then you take home less value. But for income, it's absolutely not the case. Here's how taxes on 100 USD would work. You take your first, I'm calling it an income slice, your first 10K, you subtract out the last income slice, which for this case is 0. You take your tax rate, you multiply it, you get your tax in dollars. Then you do the next income slice, subtract out the last one, you get your income for this bracket at 10%, then you get your tax rate. You do that for the last slice, and at 20%, you get this tax rate. So you get 11,500. Since this is a nice round number of 100K, we can see your effective tax rate is 11.5%. Obviously, this changes. So let's take the Roth contributions and say this guy wants to contribute 12,000 of his income before taxes. So he takes his 12,000. He has his average tax rate of 11.5% and he gets $1,380 of taxes. Now, if you want to consider the cost benefit of this tax now, if you take your highest tax bracket of 20%, then this would be 2,400. But let's just use the average rate. So because we're in the simple case. So $885 a month to investments. And you can think of things you do with playing around with your income as off the top. The stuff at the bottom is locked in, so you're only playing around at the top level. So that's why I say you could say this might feel like a cost of 2,400, because you could put that into pre-tax, all of it, and then you save $2,400 worth of taxes now, but you have to consider it later. But okay, so let's say Bob's 40 years away from retirement, and we played this into a simple investment calculator, and we can see over his 40 years, he contributes 424,000, makes 2.4 million interest, and he ends up with 2.8 mil. And holy heck, that's a lot of money, right? Makes you wonder how anyone messes up their retirement when they're making this much money. Just put in a solid amount per year and adjust your expenses accordingly, and in retirement, you have a lot of money. Um, and it's simple yet effective. That's why everybody goes this route, it seems. Um, you could complicate this a little bit and transfer your holdings once you reach retirement age into a dividend yielding stock. There's a couple options that are fairly reputable and they have um, very nice targets for their dividend rates that they tend to meet. And they also have some amount of growth, which is obviously lower growth rates because they're taking some of their income and instead of reinvesting it and growing their business, they're paying it out to their investors. Um, so let's take a 2% dividends on this large sum of money, which you're going to need if you're going to be considering dividends, and you get 57,000 of tax-free income. Dividends aren't always tax-free, but for Roth, if you take home a dividend, then it counts as nice tax-free. If you just take out money, um, then that's also tax-free. So he just takes out his money and makes it to retirement, and he's all good. Okay, now take Jordan Belfort. Jordan YOLOs his entire retirement on out of the money he puts on a startup with 0 days to expiration. They have, a bad announcement. They got denied their drug. It might cure cancer, but it also uh, destroys part of your brain. So he makes 3 billion on this call. Then, being the degenerate he is, he goes right back, puts that 3 million on, and takes out some uh, speculative trades, and he goes minus 5 million the whole in 1 week. Okay, so enough with the joke guy. Yeah, if you're thinking about retirement, don't take risky trades. Is the message here? Just put your money in well-established companies that you think have long-term potential. So let's take Warren then. Warren knows a thing or two about investing. He decides that he wants to manage his retirement funds a little more closely to maximize his gains. He makes the same 100,000. He contributes 3,000 to his Roth at 345 of his average tax rate for a total of 221.25 per month. And he takes 6,000 and puts that into his pre-tax. He pays $0 in taxes now, which you could think of as him saving his high top bracket tax rate of 20%. So he puts in 5,000 or 500 USD per month. Um, and then he also has an individual account instead of putting it all into the Roth. Um, he also takes the tax hit of 345 and puts 221.25 into his individual account. And we'll get to this in a sec. So he wants to retire in 35 years. He doesn't want to wait until 40 years when he's older, and he wants to enjoy a little bit of his money earlier and you know reap the benefits of smart investment. So his Roth turns into almost half a mil pre-tax, about a mil, and individual into almost 2.5. And we can see here the numbers, so 35, same rate. He contributes 500. This is his pre-tax. You get that 1 mil. Here's the Roth, and there's his monthly rate for his Roth. This one gets up to half a mil, and then here's the caveat for his individual. He follows the news and he understands something about these growth sectors, and he makes smart decisions with his money. He moves it around in a smart way, avoids most of the taxes, doesn't use a brokerage firm so he can realize more return rates and doesn't have to pay out to them. And basically, let's say he's a really, really good trader and he makes this 15%. There's your caveat, because when this number goes down, your total amount quickly deteriorates, because we're only working with $100,000 worth of total contributions, and most of our money is coming from this compounding returns. If you have bad years when you start out, um, this number will quickly go down. Bad numbers when you reach the end might affect a little bit, but um, as long as you withdraw at a high return, then you know you're pretty solid. But with this route, there is a huge asterisk here that this rate is not unobtainable, but extremely hard to obtain. If you were self money managing your money, odds are you're just gonna lose money. But if you know a thing or two, this 15%, it's not impossible to reach. It's pretty easy if you're doing the strategy of long-term hold in less risky options. You're not looking to make double your money type trades. Um, you're just looking for solid growth. Um, so that's the caveat here. And this strategy only works if you can reach that huge return rate. Let's say you match the market though, then you'll end up with 500K, similar to your Roth, and then you have 2 mil total to work with. Whereas the other person had 2.8. So don't do this if you're gonna um, not manage your money appropriately. And yeah, so that would be my aside there. Just be careful how you manage your money, and it is worth considering. You can bail out of your early retirement. This is after 35. If you put another 5 years in, and you keep working and you contribute more money, you'll match that 2.8 million. But um, yeah, if you set up your plans, know what you're getting into. So he retires 5 years early, and he has to replace his income. You don't touch any of your retirement accounts because those have high penalties for these early withdrawals, so you live solely on your individual account. Again, if you don't make enough money into this individual account, then you know you'll this plan goes quite poorly. Um, so for 5 years, let's just say we don't put any more money into our retirement. There's some loopholes here, but let's just say you're unemployed. Um, those accounts keep growing for the next 5 years, and they reach these totals, which is pretty good. And let's just say you cannibalize any growth to meet your 100K uh, income needs, and then you also move your money into more consistently performing stocks like a dividend stock, and you just eat all of the growth, and then let's say your money just ends up at about the same amount. Um, and you are double dipping in taxes here, but you're also taking a lower tax rate at this point in time because capital gains taxes are lower and give you a little bit more flexibility on how to withdraw. It's a little bit larger of a withdrawal limit in the bracket that you'll probably be working in. Um, but that's kind of boring. Why retire early just to have a nice big number in your account? Let's say Warren just balls out and spends all his money, and we can say he roughly breaks even on this account. You might even actually say that um, this account might go down, but you still are working with a large sum of money here. And you could even say he didn't do as well as he thought. And you could say that this account is $1 million, but you're still uh, over the retirement amount that the other person is at. But there's a caveat there with the taxes. So the interesting bit comes after retirement age. Bob is comfortable. He has no worries. He has more money than he's ever had because his house is paid off. His kids are out of the house. They make their own money. He downsized his car. He hardly drives the new one. He can finally take vacations and pursue his expensive hobbies. He has his retirement income and his social security, and he just, lives out his days worry free and even manages to leave behind nice inheritance of his house and a decent sum of money. Good for Bob. Warren isn't like Bob though. Warren wants more than comfort. He wants this lavish lifestyle that he worked hard for. He decides he needs 200K per year so that he can sail around on this yacht or whatever he's doing with his money. He takes out 200K for a tax rate of 0% for the first 50K. So it works similar to the income tax where you take your first slice and then your next slice, and you calculate the rates individually, add them up, and you get a lower realized tax rate. And so the next 15 or 150K has a 15% tax rate. It doesn't go up to the 20% tax rate. Again, all of these numbers are made up. Look up the real numbers, but the ideas are there. And these numbers also get way more favorable if you're married, so take that into mind. You might consider, looking for a partner at these ages. You just save a ton of money in taxes. So he also plans to start using a combination of his Roth and pre-tax income later on at a lower rate. If he wants a higher rate, um, the way that he put his money in, having some pre-tax income, he might have made a mistake there. But if you consider you can take some money out from his individual account and he's expecting to need less income, which is only this pre-tax amount, then you made a nice optimization here. So he takes out 80K as taxable income from his pre-tax to try and fall into that uh, lower tax bracket without getting up to the really expensive one, and to make this last throughout his retirement. Um, and he has that 75%, or he has that 7,500 tax, and that goes back to here. These first two brackets added up 7,500. And then he takes 40K from his Roth, that's non-tax, non-income. And when Bob needs some additional income, he taps into his personal account, takes the 15% capital gains hit, and doesn't deplete his Roth account so he can keep up this nice spread and not increase his tax rates. This does not increase his ordinary income. That is the word for uh, income that is taxed at the income tax rate, basically. But he will fall into a higher capital gains rate because capital gains takes your income into account and then places you in the bracket based on how much capital gains you realize. You fall into that rate. But the capital gains bracket is again much larger. It's, I think, roughly 80 to 400K right now if you're married, 50 to 400K if you're not married. And again, those numbers change, so look them up. And then in that middle bracket, the rate is like 15% or 20%, something like that. You also have to consider state taxes, and state taxes um, are flat for the entire capital gains rate. There's some nuances here, but you can basically take this calculation as like a rough, accurate measurement. Um, so if he needs less income, he can take less out of his Roth IRA and then have more later that he can, if he needs more, he can take out the Roth. That's where the extra Roth withdrawals might come from. And it's unlikely he goes down to 10K, but if you only needed 10K for a year for whatever reason, um, and he only had 10K of income, then he could take it out and have a significantly lower income tax rate if he takes out of his pre-tax. And if he needs less though, like significantly less, he probably would take it out of his capital gains because he can take out a large sum up to 50K, not married, 80K, married, at 0% tax benefits. So he just taxed at 0% for that first 50K. But even with this large spending, you can see he doesn't run out of money and he leaves more to his kids, um, or whatever he wants to do, fund a college scholarship fund, whatever he does with his money. You just need some discipline and some knowledge of investing and taxation, and you can outpace his peers. But if you don't know any of these two, you can quickly destroy your retirement funds and owe much more in taxes. So, long story short, you don't know anything, put it into your Roth IRA. You're not going wrong there. If you know a little bit more, you might spread it out. If you know even more than that, and you know something about investment, not just taxes and finance, then you can manage a personal account. And then you give yourself the option of retiring early. But that is the story there. I'll also quickly show the calculations for the last 5 years. Just normal growth with no contribution. That's how you get those growth numbers here. But yep, that's the entire video.